I'm Mr. Heat Miser, and this is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statement expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, interesting topic this week. But before I get to it, again, nothing's really come out from the FASB or the AICPA, so I'm coming up with some topics that I'm seeing as I'm reviewing work papers, I'm hearing practitioners talk about. So the interesting topic this week, at least I find interesting, is receivable borrowing. Now, if you were at the convention, there were a lot of great vendors there. There were people that did a lot of lending. There were people, merchant advocates. There are a lot of different people to talk to that relate to this topic. You would have heard and got some ideas about, lending and stuff like that. So one of the issues that I've seen lately is borrowing based on receivables. Okay, so the company has accounts receivable and they need to get some sort of borrowing, so they use the receivables as collateral. A lot of times it's referred to as asset-based lending is one of the aspects, and we're going to talk about, and then factoring. We're going to talk mainly about factoring later on. But the important thing is that I like to talk about here, or I feel the need to talk about here, is the accounting as it relates to borrowing around accounts receivable. So there was a good article I found called Factoring or Fiction that talked about ASU 2016-15. So this isn't anything new here. That ASU was titled Statement of Cash Flow Classification of Certain Cash Receipts and Cash Payments. So it sounded very vague that when you read that, and I remember when that came out, when I talked about it, it was not as detailed as where I'm going to go into, but the article was really interesting. And if you want to give me a call, if you want a copy of it, it's from the CPA Journal, so it's public information. But they talked about three particular approaches. It went into some other areas, but some three particular approaches that I wanted to focus on and go a little bit and bring to your attention. Secured borrowing, factoring with recourse, and factoring without recourse, and factoring with recourse. Okay, so the first one, secured borrowing, is very simple. The funds are borrowed by pledged receivables. So you go to the whatever institution, the bank, or some other type of company. You say, I'd like to borrow or have a line of credit or something available based on my accounts, as my accounts receivable as collateral. And what will happen regularly, and you can talk to the banks about this, they can explain a lot better detail. What will happen is they will look at your receivable agings as a certain point in time, regularly throughout the year, and they will give you a borrowing base as a driver. A lot of times, if it's they won't allow older receivables in there, and they'll also look at your collection history, stuff like that. But what I'm focusing on now is accounts receivable. The accounting for it, it's very straightforward. The balance sheet is grossed up. So you go to the institution, you say, I have this credit facility available. Here's my borrowing base. Here's what's available. Here's what my receivables are. Okay, they look at it. Okay, we'll make available to you $500,000. They loan you $500,000. Debit, cash, credit, loan. Very straightforward. Okay, just as you would think. As it relates to the statement of cash flow, as you collect the receivables, operating, and as you pay down or receive the funding or pay down the lending, it's a financing activity. Fairly straightforward. Then we get to factoring. Now this is a little bit different. And I'm seeing this more within financial statements, and I'm not an economist by any stretch of the imagination, but usually when I've seen this in the past of people starting to factor more, tells me there might be something going on with the economy. Again, don't go based on me. So, but factoring, let's talk about factoring without recourse. That means that you, in essence, sell off your accounts receivable to this factoring company, and they're going to try and collect it, and there's no recourse for them to put it back to you. So you say to them, here, I have this tranche of accounts receivable, $500,000 again. You go to them and say, here, how much will you fund of this? They will give you $450,000 for the 500. The $50,000 is a factoring fee. You received the debit cash for $450,000, factoring fee for $50,000, credit accounts receivable for $500,000. Fairly straightforward. That is without recourse. Okay, that's fairly uncommon. Okay, the more common activity is factoring with recourse. Now, what that means is I'm going to give over to you a tranche of my accounts receivable or specific accounts receivable to the factor, and if it is not collected after a certain amount of time, you can put it back to me, and I still have to pay you. So what happens is the factor has the right to return any uncollected receivables at a predetermined period. The originator has not actually transferred the receivable under ASC 860, whereas the first one, under the without recourse, then in essence they've transferred the receivable. But under the without recourse, with recourse, they have not actually transferred the receivable. So what has to happen then is, if they give you, we'll go back to that $450,000. If they give you $450,000, you are debiting cash for $450,000. You're hitting the factoring fee for $50,000, and your credit is a loan. So you keep the receivable on the books, you have the loan on the books, and you have disclosure. It relates this. Why am I picking up on this? Because I was reading a set of financials from somebody recently, and it said right in there in the accounts receivable footnote that they factor their receivables, and it is with recourse, and it can be put back to them. So at a minimum, I would have expected them to say how much is out there that they may still be on the hook for. That's what I would have at least expected to see. That wasn't there, but really what they should have been doing is grossing up the accounts receivable and the debt, the factoring payable, on the balance sheet. As you collect the accounts receivable, it winds up being an operating on the statement of cash flow, and as you pay down the debt, as you get the money or you pay down the debt, it is a financing item. This is that's very common. So if you are at a company and you're doing factoring, make sure you're looking to this accounting for it properly. If you're a practitioner and you have a client that is factoring, make sure you ask them or look at the documents to see if it is or is without recourse. A lot of times I also see when I've done peer reviews is that people don't even ask if accounts receivable are factored. They just thought it was debt on the books because the company was accounting for it properly, and they just show the statement showing that it's debt outstanding and not referencing that as a factoring relationship. Okay, so why did I say that the heat was on? Because the PCAOB came out with some recent updates to accounting and auditing standards and procedures. Two particular areas that I'm going to talk about is they have amendments to AS 1105, audit evidence, and AS 2301. Now remember, we're talking about the PCAOB, so we're talking about AS, which are auditing standards, okay, compared to AICPA, which is AU, they're auditing codification, FASB, which is ASU, accounting standard update. So I wanted to make sure we talked about that. The AS 2301 is the auditor's responsibility to the risk of material misstatement, and this area that they're talking about is addressing procedures involving technology-assisted analysis of information in electronic form. Whoa. Okay. It's meant to provide detail and clarity that will reduce the risk that auditors risk of auditors using technology-assisted analysis. So you know they're pushing a lot more for AI now. Not the PCAOB, the world is pushing more and more for AI. At the convention, there was at least 2 sessions directed right towards AI. So with movement towards AI and data mining, which was out years ago, and now moving with AI, the PCAOB is saying, okay, we got to give a little bit more guidance as to what they should be doing, what's acceptable, et cetera. This guidance would strengthen and clarify the auditor's responsibility when designing and performing substantive analytical procedures. So if you start using AI and say to AI, hey, what would I expect to happen in this situation? And what the result is, we can't have people just taking the response from AI and then putting it into the work papers. I'm not judging what AI is. I just know when I was sitting in the session, I went onto an AI app, and I said, who is Brad Muniz? And it said in there, he's a character in Breaking Bad. And I said, wow, I never knew that. And then I went into another AI app and I said, was Brad Muniz in Breaking Bad? It said no. So I'm confused and I don't know who to believe. Anyway, that's where we're going with data analysis. This last one, and the one that's really hitting and where I said the heat is on, is amendments to Rule 3502, previously titled Responsibility Not to Knowingly or Recklessly Contribute to Violations. So for a quote from the PCAOB chair, it's the align rules to what the investor already expect. So it aligns the rules to what the investor already expects, that when an associated person's negligence directly or substantially contributes to firm violations. Two more other bullets I'm going to hit on. An associated person must have contributed to the firm's violation both directly and substantially to be held liable, and aligns the rule with the same standard of reasonable care orders are required to exercise anytime they are executing professional duties. So why am I bringing this up when you're sitting here saying, why are you talking about this stuff? Because I get PCAOB emails regularly, just because I like keeping up on this stuff, even though I don't do public company work. And I'm seeing a lot of fines being issued by the PCAOB against practitioners for lack of professional care. So this is starting to really bring into light more to tell the practitioners, hey, you have to be acting responsibly, and it starts talking about recklessly and what's defined as recklessly. And I recommend watching this. This is just coming out as, looking for comments on this. So feel free to find it on the PCAOB site or email me. I'll give you some information about it and you can provide your own comment. Okay. Those are the two big items I want to talk about today. So in closing, here are some upcoming accounting and auditing events. On July 17th, the Society is holding its annual Government Accounting and Auditing Conference. On August 12th to the 14th, the Society is back in Atlantic City for the CPE cluster. Get information on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.